Good evening, everyone. Welcome to our webinar today that's all about China A shares, including what are the opportunities and how to invest in them. So joining us are our Senior Portfolio Manager, Yo Weiren, and Research Analyst, Chloe Harlan from our Stocks and ETFs research team. They will be giving a quick introduction of China A shares for investors and more on China's healthcare industry and a couple of investing ideas that investors can consider. After which, we have Marcus Cheong and Michael Wang from our securities dealing team who will guide us on how investors can start to trade China A shares on fsm1.com and the useful tools and features available there. So with that, I'll now pass the time over to Weiren.
Thank you, Sarah. Hi, good evening, everyone. Thank you so much for joining us today. My name is Weiren, and today I'll be giving everyone a quick introduction to the A-shares market, as well as some of the reasons why you should consider having some A-shares inside your portfolios. So I'd like to start off my sharing today by giving everyone an introduction to the very complex world of Chinese stock markets. Now, when it comes to investing in China, it can actually be quite intimidating because Chinese companies, they are generally categorized into many different kinds of share classes. So you may have heard of A shares, you may have heard of H shares, but there are actually a lot more different kinds of share classes out there. And the categorization depends on the company's place of incorporation, their listing location, as well as the currency that the shares are being traded in. Now, the majority of Chinese companies, as you can see from this slide over here, the majority of them are actually A-share companies, and A-shares actually occupy about 70% of the overall Chinese equity markets. And A-shares essentially just refers to Chinese companies that are incorporated within mainland China and are listed on the Shanghai and Shenzhen stock exchanges. Now, we also have B shares, which is relatively similar to A shares. They are also incorporated in mainland China, and they are also listed within mainland China as well. But the key difference between A and B is that B shares are denominated in a foreign currency, typically USD on the Shanghai Stock Exchange and HKD on the Shenzhen Stock Exchange. But as you can see, B shares are an increasingly irrelevant part of the Chinese equity market because they are actually a very small part of the entire Chinese equity universe. And then outside of mainland China, there are also companies that are listed primarily in Hong Kong as well as in the US. So our key focus today is on the A-shares market. And I think this is a very interesting market because it is the largest market, but yet for many years, foreign investors, we had limited access to the A-shares market. And the only way for us to invest in China's growth story was actually to invest in the Chinese companies that are listed offshore in Hong Kong as well as in the US. But as I've mentioned just now, this is actually a very small part of the entire Chinese equity market. But this has changed because with the opening of the A-share market, we now have access to this 70% of the market that was previously unavailable to us. So the Asian market is a big market, and it is certainly an opportunity that is too big to be ignored by us. So China is actually big in many ways. It has the largest population in the world. It is the second largest economy in the world, and it is also currently the largest exporter of goods in the world. But besides its population and economy, China's capital markets are also amongst the largest in the world as well. So its bond market, for example, is the second largest in the world. And the A-share market, it is also the second largest in the world as well, just behind the US. Now, if you take a look at the chart on the right, you can see that the combined market capitalization of the Shanghai and Shenzhen stock exchanges is about 13.4 trillion US dollars. And this actually accounts for about 11% of the global market cap. But like I said just now, in the past, foreign investors have largely been restricted from investing in A shares and the only way for them to invest in China was primarily through the Hong Kong listed as well as the US listed Chinese companies. But this has changed because the Chinese government has launched a number of initiatives that enable foreigners like us to access the A-shares market. So one of such initiatives is actually the Stock Connect program, which is something that needs to be mentioned because this Stock Connect program has significantly lowered the barriers for retail investors, foreign retail investors, to trade A-shares through the Hong Kong Stock Exchange. Now, the Stock Connect program is basically a scheme by the Chinese government that seeks to integrate the Shanghai and Shenzhen stock exchanges with the Hong Kong Stock Exchange. And it is this scheme that allows foreign retail investors like us to easily trade Chinese A shares. Now, one thing to note about the Stock Connect is that it only allows partial access to the A shares market, which is why if you look at this chart on my slide, you'll see that even though the entire A-shares market has more than 4,200 listed companies, the Stock Connect actually only covers about 2,380 securities. Now, this is still a much bigger opportunity compared to what is being offered in Hong Kong and the US. And on top of that, most of the major companies and major industries in the Asian market, they are included in the Stock Connect. The stocks that are not being included in the Stock Connect, they are mainly small cap companies. So you aren't really losing out on anything because a large part of the A-share market is being captured by the Stock Connect. So the important question that investors have in their minds is, of course, should we have some exposure to A shares inside our portfolios? Now, the answer to that question is, of course, I think yes. And the first reason for that is because I think A shares, they actually offer investors very unique opportunities to monetize China's growth. Now, the A-share market is distinguished from other equity markets not only by its size, but also in terms of the diversity of its investment options, because a lot of Chinese companies can only be found exclusively in the A-shares market. Now, there are some companies that are dual listed in both mainland China as well as the Hong Kong Stock Exchange, but this is actually a very small subset of companies. In fact, there are only about 136 companies that maintain a dual listing on the Hong Kong Stock Exchange and the mainland stock exchanges. So most companies in the Stock Connect, they are exclusively listed on the Shanghai or the Shenzhen stock exchanges. And on top of that, the A-share market also provides investors with access to companies in certain industries that are unavailable or limited in other stock markets. So there are certain opportunities in China that can only be accessed via the A-share market. And I've also listed a couple of examples on this slide. So, for example, the alcoholic beverage industry in China, I think that's a good example to illustrate the fact that certain industries are only available in the Asian market. So, for the alcoholic beverage industry, I think something interesting about this industry is that China is actually the world's largest consumer of alcoholic beverages. And this alcohol market is being dominated by baijiu companies because baijiu is the most popular drink in China and it is often considered to be China's national drink. So if you want to get exposure to this particular industry, the only way for you to do so is to buy the stocks of the leading baijiu companies in China, such as Guizhou Maotai and Wuliangye. But all of these companies are only available in the A-shares market. So same thing for some of the other industries that are listed here. I think the semiconductor industry is also another good example. SMIC is probably the most prominent Chinese semiconductor company. So SMIC is listed in Hong Kong and it is quite easily accessible to foreign investors via the Hong Kong Stock Exchange. But other than SMIC, there aren't a lot of options available outside of mainland China because most semiconductor stocks in China, they are listed in the A-share market. And electric vehicle industry as well, I think that's also another good example. So for the Chinese EV industry, I think most investors will probably be familiar with the car manufacturers like NIO, Li Auto, I think these are all options that are available in the offshore markets, but the entire EV value chain is actually a lot bigger than just the car manufacturers, because you also have the battery makers, you got the electrolyte suppliers, and then you also got the strategic metals industry, which is a very important industry because it produces important metals like lithium, cobalt, and copper. And these metals are critical not just to the EV industry, but also to the entire clean energy and the renewables industry as well. And again, a lot of these opportunities are only exclusively available in the A shares market. Now, the second reason why you should consider having A shares inside your portfolio is because regulatory risks are less acute in the A shares market. And this is true especially for this year because A shares in general have done a lot better compared to the ones that are listed in Hong Kong and the US. And Chinese internet companies like Alibaba, Tencent, and Meituan, they have all been bashed down this year because of the tough regulatory crackdown by the government. Now, for those of you who have been following our research reviews, you probably know that we are actually quite positive on the long-term prospects of these Chinese internet companies and on the tech industry in general. And we think that the recent sell-off is actually a very good buying opportunity. But this may not be for everyone. This may not be suitable for everyone because the reality is that the regulatory environment within China is very uncertain at this point. And with this uncertainty comes volatility as well. So if you're not comfortable with the volatility that comes along with this uncertainty attached to the regulatory environment, then A shares is actually something that you might want to consider because certain industries and companies in the A shares market actually benefit from some of the recent regulations and policies that the Chinese government has actually implemented. So, for example, China's decarbonization campaign, I think that is expected to benefit companies that that range from electric vehicle suppliers to your solar energy equipment makers. And similarly, China's efforts to achieve self-sufficiency in the area of semiconductors. So that is also expected to boost domestic semiconductor manufacturers as well. And also companies that are operating in the areas of AI, 5G, industrial automation, these are also likely beneficiaries of government policies. So China's long-term commitment to supporting these industries, it has actually created a fundamental earnings tailwind for the companies that are operating within them. And many of these companies, again, can only be found within the A shares market. And also in the longer term, I think it is the priority of the Chinese government to develop a robust capital market infrastructure because China's capital markets, they remain underdeveloped relative to its other peers like the US and Europe. And it is also because of this that there has historically been a heavy reliance on debt financing in the economy because companies can't raise funds efficiently in mainland China through the domestic stock market. And this is also the reason why China's corporate debt to GDP ratio is one of the highest in the world right now across developed economies. But this is going to change because the government has been actively pushing forward its capital market reforms, and it has made the development of its domestic stock markets one of its top priorities. The fact that the STAR market and also the upcoming Beijing Stock Exchange, these are both initiatives that are championed by the president himself. So I think that is also a sign that the government actually expects the domestic stock market to play a larger role in the future. And that also means that policy is likely to be supportive of the A share market as well. And third reason why you should consider having A shares inside your portfolio is because A shares can provide diversification benefits, given that they have historically displayed low correlation with other major equity markets. So since 2001, the correlation between A shares and global equities has actually been quite low at 0.25. And on top of that, correlations with major equity markets like the US, Europe, and Japan, they have all been low as well, ranging from 0.17 to 0.25. And even for emerging market equities, its correlation with A shares is actually just 0.36. Now, there are a couple of reasons that explain the low correlation, such as the dominance of retail investors within Asia's market, low ownership by foreign investors, and also capital controls, which is why the Asian market, it tends to be driven more by domestic expectations and demand rather than global events and what is happening out there in the world. As China continues to open up, as China continues to integrate itself more with the global financial system, so this correlation is expected to pick up. But the market at this point still remains at the early stages of its global integration. So A shares should continue to provide diversification benefits for investors. And this year is a good example. The A share market has been relatively resilient, even with the tough crackdowns across various industries in China. And this chart basically shows you the performance of the various China stock indices in 2021 so far. And you can see very clearly that the A share market, which is indicated by the CSI 300 index over here, it has actually held up much better compared with overseas listed Chinese companies. And I've actually compared the performance of this index to several other indices like MSCI, Hang Seng Tech, Nasdaq Golden Dragon, as well as the Hang Seng China Enterprise. So all of these indices, other than CSI 300, so MSCI China onwards, so all these indices, they invest primarily in companies that are listed in offshore markets. So your Hong Kong Stock Exchange as well as the US stock exchanges. So there is a clear disparity in the mainland Chinese, the onshore listed companies versus the offshore listed companies. Okay, so I hope by now I have given you enough reasons to want to get started with China's A shares market. So how do you get started in this very big market? Stock picking is, of course, the most obvious way to get started in China's A shares market. But for those of you who don't know what companies to invest in, the easiest way for you to get started is still through ETFs. And I've actually listed a couple of ETFs here for you to consider. So for broad-based market ETFs, you can have a look at two ETFs. One of them is 2823, which is the iShares FTSE China A50. The other one is 2846, which tracks the performance of the CSI 300 index. And also for investors who are looking for a more thematic approach to the A shares market, I have also listed a couple of suggestions over here. So these are all thematic ETFs listed on the Hong Kong Exchange, giving you exposure to semiconductors, EVs, as well as the clean energy industries in China. And like I've mentioned just now, these industries are expected to benefit from supportive government policies in the future. So if you don't know which companies to invest in, then I think these ETFs that I have listed here, they are very simple and they are also a very straightforward option for you to get started with the A shares market as you continue to do your research into the A shares market and decide what companies you want to invest in. So with that, I've come to the end of my sharing, and I hope this has been useful towards your understanding of the overall A shares market. And now my colleague, Chloe, will actually come in to share with everyone more about the healthcare industry in China and where she thinks the investment opportunities are within these industries. So I'll hand the time now to Chloe. Chloe, over to you.
Okay, thank you, Aaron. So give me a moment to share my slides. So good evening, everyone. So I'm Chloe. I'm an equity analyst from iFast. So thank you very much for joining us for tonight's webinar. And today I'll actually be sharing more about China's healthcare sector, as well as identifying one stock that you can actually consider investing in. So here's the outline for my presentation today. So to start off, I'll actually be giving an overview of China's healthcare sector with regards to some of the secular trends and the recent key developments. And this would actually help give an idea on why we actually recommend Jiangsun Hengrui as a stock idea for China's healthcare sector. So first and foremost, the demand for healthcare in China is actually growing exponentially. And this is actually backed by secular trends such as an aging population, as well as a chronically ill Chinese population. And we'll be actually looking at these two trends within the next two slides. So China has a rapidly aging population. the number of Chinese citizens above the age of 65 years and above has actually reached about 160 million in 2019, and they actually represent about 11.5% of the total population. And this proportion of elderly is growing steadily and is actually expected to further increase. And this is actually the result of the lingering effects of the one-child policy that was implemented by China in 1979. And according to the World Bank, this number of elderly, which is expected to rise to 310 million, and they will make up about 23% of the total population by 2050. So this number is so significant, as by then, China's enormous elderly population is also actually estimated to exceed those of US, Japan, and Europe combined. Additionally, China's fast-growing society also means there's an ever-growing need for healthcare services. And this spike in demand is actually further compounded by a rising prevalence of chronic diseases. So overall, China's aging population is actually expected to increase the burden of chronic diseases by 40% by the year 2030. And currently, almost 80% of the deaths in China for those who are aged 65 years and above are actually a result of chronic diseases, with cancer, heart disease, as well as diabetes being the top causes of death. The result of both these factors is that China is now one of the fastest growing major healthcare markets in the world. So its growth rates have by far exceeded other healthcare markets, as seen in the chart here. And China is actually expected to grow at a 5-year compound annual growth rate, or CAGR, of 11%, compared to just 4% in the US and negative 4% in Japan. And this is actually what makes China's healthcare sector attractive to investors as well. So additionally, the healthcare sector in China has also undergone some significant changes over the years. And to actually get a better understanding of China's overall healthcare landscape, we'll be actually looking at some of these key developments. So China is the world's second largest pharma market after the US. And as part of its Made in China 2025 industrial plan, the country actually hopes to reinvent their biopharma industry. So the president himself actually identified his country's reliance on foreign drug imports as a critical concern, and actually aims to improve China's biopharmaceutical industry to actually counter this reliance on foreign firms. And one way to do so is actually to increase emphasis placed on innovation, as well as homegrown research and development within this whole industry. So it's unsurprising to see that over the years, there's also been a shift in focus from generics to that of more innovative drugs, as China actually strives to move up this biopharma value chain. So generics are drugs that actually contain a chemical substance of a drug that was originally protected by patents. So generics are allowed for sale after the patents on the original drugs expire. And historically, the majority of drugs in China's national reimbursement drug list have actually been generic drugs. But over time, an increasing number of innovative drugs are now being included. So this reimbursement drug list is actually quite important, as it actually determines how drugs are covered under both national as well as provincial health insurance program in China. So China's large pharma companies have also been trying to develop more innovative drugs to help cushion the impact from China's volume-based procurement program. So this is a program that was actually introduced in November 2018, and they actually target generics. So this program involves public hospitals purchasing a large volume of generics for significant cost savings. And thus, price pressures could actually spell the end for those generic drug makers who fail to innovate, and would help to spur more innovation within China's healthcare sector. And besides this, other developments to actually foster a more vibrant healthcare market include, most notably, a faster approval for China's national reimbursement drug list. So in the past, the average time delay between the first mainland China approval and its NRDL listing has actually reduced dramatically from about 37 months in 2016 to just 10 months in 2020. And reducing such delays would actually allow for drug manufacturers to maximize their market penetration as well before they actually lose their patent protection. And all in all, this helps to lead to a more robust market by actually encouraging innovators as well as rewarding manufacturers of novel therapies. So now that I've given a brief background with regards to China's healthcare sector, let me introduce a pharma company in China, which we believe is actually well poised to benefit from the secular growth drivers, as well as some of the key developments as mentioned earlier. So this is Jiansu Hengwei Medicine. So this company was actually founded in 1970 and is China's largest listed pharma company. So it's also a notable name within the oncology market. And it was actually one of the first few pharma companies in China to transform its business model from developing generics to more innovative products over the years. And when we look at the company's business model, essentially it operates via 4 key segments, which is that of oncology, surgical anesthesia, special infusions, and contrast agents. So unsurprisingly, given that this company is known for its anti-tumor drugs in China, oncology is actually its biggest and largest segment, and it actually contributes to about 55% of the company's overall revenue in FY20. So we like Jiansu Hengwei because it's focused on oncology, and given that oncology is by far the largest field of pharmaceuticals in terms of not just the current as well as the forecasted spending. And you can see this in the chart over here, that analysts actually expect the worldwide yearly spending of oncology drugs to actually reach about 311 billion by 2026. And this is actually up from 145 billion in 2019. And all in all, this represents a compound annual growth rate of about 12%. Moreover, when we look at China, cancer is among the country's 5 high-priority disease areas, and this was further emphasized by the Chinese government's Healthy China 2030 plan. So cancer in China is actually so prevalent that about roughly 50% of the global gastric cancer, liver cancer, and esophagus cancer is actually diagnosed from patients in China. And what makes this worse is that the burden of disease is further worsened by the late diagnosis. So about 55% of patients in China are actually diagnosed with liver cancer in the late stage of stage 3 and 4. And this is much higher compared to 15% and 5% in US and Japan respectively. So seeing the high prevalence of cancer within China, it also means a vast and growing market for oncology drugs. So going forward, we believe that oncology drugs will actually continue to fuel Jiansu Hengwei's growth. And Jiansu Hengwei has an anti-tumor drug known as camrelizumab, and camrelizumab has actually been approved in China for patients with hard-to-treat Hodgkin's lymphoma. But in March 2021, the company actually managed to expand camrelizumab beyond treating Hodgkin's lymphoma to other forms of cancer such as liver cancer, esophagus cancer, as well as lung cancer. And if you notice, these are also the common kinds of cancers in China. So additionally, camrelizumab's national reimbursement win in China actually covers more indication, or what is also known as treatments, compared to its rivals. And this actually helps to strengthen the company's oncology franchise. And according to Bloomberg, it's estimated that this drug alone could actually generate about 4.6 billion yuan in terms of total sales for the company going forward. Besides this, another point I also want to highlight is that Jiansu Hengwei is actually considered to be a leader in innovation in China, and this can actually be attributed to its strong R&D spending. So this is especially important given that I already mentioned that China is trying to focus more on innovation to move up the value chain. And increased R&D spending would actually help to drive the development of innovative drugs, which offer higher margins compared to generics. And historically, you can see here that China pharma firms have actually lagged behind global peers when it comes to R&D spending. But Jiansu Hengwei has actually consistently invested in R&D, and its R&D spending actually accounted for 18% of its FY20 revenue. And this is actually quite comparable to the 20% of the global peer average of 20%, and also much higher than its other large domestic rivals such as CSPC Pharmaceuticals, Shanghai Fongsong, as well as Hang Seng Pharmaceuticals, as seen here. So naturally, as a result of this strong R&D spending, the company is actually ahead of its peers with multiple oncology drugs being launched, as well as a deep pipeline of oncology, autoimmune, as well as diabetes drugs that are currently in phase 3 trials. So at present, the company has about 6 innovative new drugs that are approved for marketing, and 4 of which are oncology drugs. Moreover, the company has actually applied for 894 domestic invention patents and has about 487 authorized patents worldwide. So we believe that actually going forward, the company would actually keep investing in R&D, particularly in the area of oncology drugs. And with the high prevalence of cancer in China, developing such innovative oncology treatments would enable them to unlock the huge potential of China's healthcare market. However, do note, like all investment, they actually come with their risks. And so here are the key investment risks to take note of for a company like Jiansu Hengrui. So regulatory risk is actually something to consider in face of the recent government crackdowns in the tech as well as private education sectors. So naturally, there are some fears that the regulatory pressures could actually hit the healthcare sector next. Another thing to note is that in China, most biopharma firms need to have their drugs listed on this NRDL list to actually be commercially viable. And negotiations typically involve price cuts of an average of 50% in exchange for much larger sales volume as well as wider patient access. Another key risk is that pharmaceuticals can actually be considered a high-risk industry, as drug development is inherently unpredictable and can come at a risk of a loss of investment. So moving on to the valuations of Jiansu Hengrui. So Jiansu Hengrui's recent share price weakness has actually created an attractive entry point. And again, this is due to the heightened regulatory risks in China following the government's extensive crackdowns on the tech as well as tech sector. And so this led to fears that, again, healthcare sector could be hit next. And in view of this, we actually assign a fair PE multiple of 42 times to Jiansu Hengrui. And this is actually a discount, as historically the company actually trades at a forward PE multiple of 47 times. There's more room for upside when it comes to this company, as our 2023 target price for Jiansu Hengrui is actually 68 yuan. And this translates to an upside potential of about 35% based on the last closing price. So all in all, the company has actually invested heavily in R&D and has an innovative drug portfolio, particularly in the area of oncology. And it remains well positioned for growth, especially with the shift towards innovation and the high prevalence of cancer within China. However, if you instead prefer a more diversified approach to investing in China's healthcare sector, do consider the Crane Shares MSCI All China Healthcare ETF, also known as CURE. So CURE is actually listed on NYSE and reflects the equity market performance of Chinese companies that are listed in the mainland, Hong Kong, and the US who are engaged in the healthcare industry. So this ETF comes at an expense ratio of 0.65%. And looking at the holdings of a CURE, you'll find that Jiansu Hengrui is actually the 4th largest holding of the CURE ETF with a weightage of 4.22%. So this is my last slide. So all in all, I actually want to reiterate that the structural tailwinds, such as an aging population, as well as a chronically ill population, is actually driving China's long-term healthcare market growth. And hence, this market should actually not be overlooked. And with this, here are some of our investment ideas for those who are actually interested in China's healthcare sector. So for the single stock idea, we recommend Jiansu Hengrui Medicine, and this is China's largest listed leading pharma company who is known for its innovative oncology drug portfolio. But for those who instead prefer a more diversified approach, you may actually consider the Crane Shares MSCI All China Healthcare ETF, also known as CURE. So with this, I actually come to the end of my presentation. So thank you very much. I'll now pass on my time to Marcus.
Hi, thank you, Chloe. Just me one moment while I share the slides. Okay. Hi, I'm Marcus. I'm actually from the securities trading team. So today I'll just do a brief touch on how to start trading in China A shares. So for those of you who wanted to start to trade China A shares but just not too sure on how to start, so this particular segment can do a brief introduction on how to start. So first and foremost, before you can trade China A shares, you need to apply for what we call the ECAN ID. So the ECAN ID is actually the short form for broker to client assigned number. So for this ECAN ID, what happened is you actually issue a unique number to all the clients who are going to invest onto the China A shares. Okay, so after that, what you need to do is you need to go to the account settings, all right, and then go for the ECAN declaration. So if you are pushing your request before 2 p.m., so you will have your activation done within the first business days. So let's say if you do it after 2 p.m., you need 2 business days for the approval. Okay, so how do you start trading in China A shares? Let's say if you are not too sure on our particular platform, what you can do is you can actually look at the screenshot. Through the web, you can just go to the account settings. And through the account settings, you can actually select the fourth selection, which is the China A shares. And then after that, you can just do a declaration from there. So if you are very familiar in using the phone app, you can just go to the menu and then go to the account settings. From the account settings, you can select the activated products. From there, you can actually select the declaration for the China A shares. So for those who is new to the platform, not too sure how to do the foreign currency exchange. So for China A shares, we'll be investing in Chinese yuan. So which means that if you're holding the currency of Singapore and Singapore currency or US currency, you will not be able to actually use that to trade without the conversion. So you can actually go to the website under the cash solutions, all right, then go to the foreign currency exchange. And from there, what you can do is you can just do your FX transfer from whichever currency to the Chinese yuan. Then for the phone app, what you can actually do is just go to trade under the cash solutions and then select the foreign currency exchange. So this is just the highlight on the China A shares trading hours. Okay, so the trading hours will start from 9:15. This is the opening call auction from 9:15 to 9:25. But you can place order as early as 9:10. So between 9:10 to 9:15, the order will be kept in the Hong Kong exchange. And then after that, when the China Connect opens, they will actually push through the orders to China. So of course, from 9:30 to 11:30, this is the continuous trading session. And then followed by the lunchtime, will be 11:30 to 12:55. And then followed by a 5-minute input from 12:55 to 1 o'clock. Then after that, after the lunchtime, 1 o'clock to 2:57, this will be the second segment of the trading. Then followed by the closing, followed by the closing segment of from 2:57 to 3 p.m. So for China A shares, the minimum bid size will be at 0.01 cent, and then the bought lot will be at 100 shares per bought lot. So if you are buying less than that, which means that you'll be buying on bought. So settlement period for China A shares will be short. You'll be at T+1. So which means that if you were to sell your China A shares, you will get your proceeds in cash into your cash account on T+2 after 1:30 a.m. So what you take note to trade China A shares, I think first and foremost, it's very unique in the sense that in comparison to China, in comparison to Hong Kong markets and Singapore markets, the China A shares don't allow any intraday trading. So which means that which means that you are only allowed to sell your stock 1 day after you have bought it. So if you want to do any intraday trading, it's not allowed for China A shares. Amendments is not allowed. You can either place new orders or you can only cancel. So there is no amendment. So delay pricing for China A shares, there is no live prices at the moment. So for the order type, you'll be limit price only, limit orders. There is no good till date, only day orders. So for the payment mode, you will be under cash account. There is no auto sweep. So you can't use the auto sweep to actually buy China A shares. Trade amalgamation is available, but so it's only available if you're buying the same stock, on the same site on the same day. So it's for amalgamation. So buying for odd lots is not allowed. So you can sell your odd lot, but you can only sell the odd lot in a single tranche. So for example, if you have 107 shares, okay, you can't say I want to sell 103, leaving the remaining odd lot in your portfolio. So that's not allowed. So it's either you sell 100 or you sell for the odd lot 7. So there is no odd lot online selling. You have to call the dealing hotline to help you to sell for the odd lot. Okay, so for China A shares, of course, the China B shares and ETFs is not available. Bonds is also not available for the China A shares trading service. I think some of the questions that I saw earlier was some of the shares are not available in our trading platform. I think those that are not available most probably are from the Star market and the Chinex market. So these markets are actually for the institutional professional investors. It's only available for their investing. So it's not available for retail clients. And for China A shares trading holiday schedule, you will follow both the Hong Kong as well as the China-Hong Kong schedule. So I'll give an example. If let's say the China is not on holiday, but the Hong Kong is on holiday, so there is no stock connect. So there is no trading for stock connect China A shares. Okay. So other than introducing the rules and then of the trading, I want to introduce also the useful tools on how you can select your China A shares. So the first one I want to introduce is the market performance. Okay, so this particular tool has been here for in the website for quite a while already. But of course, this is my favorite in the sense that I can actually see the different market performance for each sector. So if you go to the stock page, you will see this particular panel here, and then you can select the different markets that interest you. Okay, so so another good trading tools that we can actually see is the stock screener. So the stock screener is what you can do is you can actually select your own exchange and then to select the sector. And after that, when you select the sector, you can actually put in your own criteria. So under the criteria, you can put maybe I want the P ratio to be maybe 30 to 50 times, P ratio to be maybe 1 to 2 times. And then from there on, you can actually screen the particular stock that fits in your criteria. So maybe I give an example. I want to search on energy sector, and then I click on screen. And then what happens is it can actually shows you the different stock which fits into your criteria. Of course, the criteria, it's not fixed. You can actually modify your criteria by clicking onto the modify. And then there's a lot of different selections that you can select. And of course, you can actually play around with that and then to select your particular stock that interests you. Okay, the next one is also one of my favorite is thematic portfolio. So the thematic portfolio actually allows you to see the different categories of stock. It could be a different theme in the sense that the income focus list or the growth focus list. So for those who are new in investing in stocks, you're not too sure what to buy, and then not too sure, no, I want something that gives me a steady income, but I'm not too sure how to start. So maybe you can go into this thematic portfolio to take a look, and then you can actually see under the income focus list, for example, you can actually see that they actually shows you a different bank, different stocks, and then they will show you the different dividend yield and also annualized return. So from there, you can actually pick your stock, and then you can see what interests you, and then you can start trading. So for those who wants to know how to see the top volume, you can go to the trading platform, all right, and then you just go to the stock top trading volume, and then you select the exchange. So yeah, if you are interested in trading Shanghai or Shenzhen, what you can do is you can select the exchange on the right hand side, then click on the top volume traded, and then you can see there's all the stocks are all there for you to see the performance, whether or not they're going down or going up, what is the percentage up or down, etc. So I come on to my last slide. So this is another way of to search the China A shares. So like for example, you have heard a particular stock from a discussion with your friend. You can actually go to the top right hand corner of the page. What you can do is you can actually go into the search mode, and then to search the particular stock. And from there, you can actually see the different information like stock information, valuation, financial information, dividends. And if you think that this particular stock interests you, you can click on the live trading, and then you can actually push this particular name into your watch list, and then you can start buying. Okay, so that's the end of my segment. So I think other than the new markets that we introduced, we also want to take this opportunity to introduce the new features that is rolled out just recently. So the new features are all trading related. These are all the market orders, the price trigger orders for SGX, or the stock order for the US. So my colleague Michael will be doing an introduction for the new features. Michael, hand over to you.
Hi, thank you, Marcus. Allow me to share my slide. One moment. Hi, good evening, everyone. Michael from the dealing team. Today, I shall brief on the advanced orders. And this includes a market order, US order, and also the SGX price trigger order. All right, market order. This function is available for the Singapore and the US market. What are market orders? A market order is an order to buy or sell the stock at the market's current best available price. A market order typically ensures an execution with a specific price quantity, but it does not guarantee a specific price. When do we use a market order? Well, we use a market order when the priority is to get the order filled and the price is not a concern. What are the risks of using a market order? There is no guarantee that an order will be filled at the target price. A buy order could be filled at a much higher price than intended. If the prices are changing rapidly, the prices filled and the prices quoted to you when your first place order can be different. This is worse when investors try to use market order for illiquid securities in a volatile market that can be filled with a much higher price than expected. When can I place a SG market order? Generally, you can place a buy market order during open session. This is a session when the market is actively trading. It's between 9 a.m. to 12 p.m. and 1 p.m. to 5 p.m. For sell, we don't have much restriction, and you can place it almost any time during the exchange hour as well as after the exchange hour. The timing listed in this table can be found in our FAQ. And when can I place a US market order? Similarly, you can place a market buy order during the open session. For sell, there's no restriction. Now I've come to the end of this market order presentation. I shall move on to the next advanced order presentation, and that is the stop and stop limit orders. And these are for the US markets only. Stop and stop limit orders are just a market order or limit order with an activation price that triggers the order. When do I use a stop order? There are various ways. Investors can use a buy stop order to buy stocks when they reach the activation price, and they can also use a sell stop orders when trying to limit their potential losses. Stop order will be converted into an actual market order in the order book once the trigger price as specified by the investors has been met. Example of a sell stop order. When the trigger price is reached, an order will be placed to sell the stock at the next best available price. The benefit is, the stop order may help the investors to get out of the position quickly. The risk is that the next available price could be lower than what the investors had anticipated. If the investors use a stop limit order, when the stock price falls to the trigger price, it will trigger a limit order to fill at the limit price or better. The potential benefit is being able to control what price the stock is sold at. But there's also a risk of the stock falling so quickly that the limit order is never filled. So stop order versus stop limit order, which is better? Each has its own strengths and weaknesses. Stop order typically ensures that the trade is executed, but the price is not guaranteed. It is best used when getting out of a position is a priority. Stop limit order ensures that you get the price that you set, but it doesn't guarantee that the trade will be executed. It is best when you don't mind holding for your desired price for a longer period of time, but if the stock keeps falling and does not go back up, you could be left with shares worth a lot less. There are certain conditions to fulfill when placing a stop order and stop limit order. So when placing a stop order to buy, the trigger price must be higher than the ask. When placing a sell, the trigger price has got to be lower than the best bid. For stop limit order, there's an additional step. For buy, first, the trigger price must be higher than the best ask. Second, the limit price for the limit order to be triggered must be higher or equal to the trigger price. For sell, the trigger price must be lower than the best bid, and the limit price must be lower or equal to the trigger price. This is an example of placing a stop buy order. Note, the trigger price has got to be higher than the ask price. For a sell stop order, the trigger price has to be lower than the best bid. For a buy stop limit order, the trigger price has got to be higher than the ask price, and the limit price has got to be higher or equal to the trigger price. In this example, your order will be blocked if your limit price is not equal to or lower than the trigger price. So when can I start to place the orders? You may place the orders during the pre-open and open session. That is 30 minutes before the trading starts till the end of a trading day. So what to take note? What these two sentences mean in short is, assuming you have placed a stop limit order for 30 days. On the 10th day, your order got triggered. Your limit order that got triggered will be in the queue for the remaining 20 days. If the order is not triggered at all, at the end of the 30 days, it will expire. This is the end of my US stop orders presentation. I shall move on to the next and also the last presentation for today, the SGX price triggered order. Okay, what is price triggered order, PTO? The PTO allows market participants to buy or sell an instrument when the trigger price condition is reached. What can PTOs be used for? Number one, it can be used to minimize a loss. And number two, it can be used to initiate a new position. So these are very similar to the US stop orders. Is there any difference between a US stop order and an SGX PTO? Yes, there is. PTO has got more flexibility in setting up its trigger condition. As you can see, the trigger condition is made up of three components: the trigger price type, the trigger price direction, and the trigger price itself. Under the trigger price type, there are 3 options: the last done, the best ask, and the best bid. Under the trigger direction option, you have greater than or equal to and less than or equal to. From here, you can see that there's more combination available for investors to craft their strategies. Here's an example of how you can use PTO as a stop loss order. First, you set a trigger price where you want a sell order triggered. In this case, I wanted to sell all my shares at the market when the best bid is lesser than or equal to $12. If the stock falls to or below this price, it triggers a market order and sell your stock at the next best available price. You may not always want to sell your shares straight to the market right after your order is triggered. You can choose to queue at a higher price or for more than a day, up to a maximum of 30 days. Here, I want my order to be triggered when the last done price is lesser than or equal to $12. When the last done price hits $12, my analysis tells me that there might be a slight rebound. Hence, I want to queue my shares at a higher price of $13, and I want to queue at the price for 30 days. So PTO market versus PTO limit, strength and weaknesses. Okay, these are very similar to the stop order and stop limit order for the US market. PTO market basically ensures that the trade is executed, but the price is not guaranteed. Best used when you want to get out of the position quickly. PTO limit ensures that you get the price that you set, but it doesn't guarantee that the trade will be executed. So it's best when you don't mind holding for your desired price for a longer period. But the risk is if the stock keeps falling and does not go back up, you can be left with shares worth a lot less. Here's how the front-end interface will look like for FSM when you're placing an order. First, choose buy or sell. Under the order type, select price trigger option. Third, set the condition. You can think as this way. I want to buy if the last done price is greater than or equal to $32. Number 4, select limit or market order. Number 5, here you can choose between a day or a GTT order for your PTO limit order. This day or GTT order applies to the order that's going to be triggered, not applicable to the main PTO order itself. Meaning only if the PTO order is triggered, the limit order can be a day or a GTT. Main PTO order is only a day order and will be expired at the end of the trading day if it's not triggered. Number 6, input the limit price you wish to place, and lastly, the quantity that you wish to place. Some additional notes for the PTO. PTO expires at the end of a day if not triggered, as what I've mentioned earlier. If PTO is triggered, the limit order can be a day or a GTT order. No restriction to the trigger price. Basically, you can input any price. For example, if the current price is $1, you can actually set your trigger price as $2. But as PTO is only a day order, a faraway price may not have a high chance of getting triggered. Third, limit order has to be within the SGX price spread of plus minus 30 ticks. Meaning, if, for example, your trigger price is $31, the highest price you can place is $31.30, and the lowest price you can place is $30.7. So when can I start to place orders? Placement can be made during open session from 9 a.m. to 12 p.m. and from 1 p.m. to 5 p.m. Amendments can be made during open and pre-open session, as shown in the table below. For amendments, no amendment can be made to the triggered instruction. You can amend the limit price, but has to be within 30 ticks of the triggered price. Quantity can only be amended downwards. I have come to the end of my presentation. Now I shall hand over my time over to the host, Sarah.
Thank you for staying tuned to hearing all about A-shares trading, as well as listening to us go through how we are able to trade on the fs1.com platform. So Yeah, thank you once again for joining us. We'll end off the session here. Thank you.